Hi there, everybody. How you doing? This is Jeremy, and welcome to FXIFY Pulse, the show where we help you trade smarter. So before we get going, I need to take a moment and read through this risk disclaimer. I'll be back with you in 15 seconds. All right, everybody, welcome to FXIFY Pulse. My name is Jeremy Wagner. Glad to have you here with us today. And we've got several key markets that we're going to take a look at today. I'm going to start off with the Nasdaq and S&P 500. Then we'll move over into the metals. And then from there, I want to take a peek at oil. We haven't talked about that one since last week, and brush up on it, as well as dollar CAD is my favorite FX market for the moment is dollar CAD. So starting off here with Nasdaq and really S&P 500, they're, birds of a feather flock together. And so with Nasdaq and S&P 500, their patterns are very similar in that it appears that we are in the beginning stages of a larger bull trend. I say a larger bull trend. This is within the context of a 4-hour chart. Obviously, this thing's been in a bull trend for a couple of years. So, but the decline that we saw here on Nasdaq going from the high in early June down to this low in late July, that correction appears complete. And now prices are rallying in my opinion, what needs to be a motive wave, an impulse wave to come up here and push into new all-time highs. So NASDAQ has yet to do that. So that implies that, there's just an incomplete pattern to the upside, and that dips are likely going to be contained and temporary. So where are we at? You'll notice that I've got these labels on the chart. Let me just take a moment and go through a couple of things that you're going to see on my chart. Number one, you're going to see these labels, XYZs, actually ABCs, WXYs, 1, 2, 3, 4s, Roman numerals, 1, 2, 3, 4, 5s. Those are Elliott Wave labels. And I use Elliott Wave as a means to help frame the market. Elliott Wave can help determine what the direction of the near-term trend is. It can also identify where we are wrong with a particular analysis, and then where it may travel to. So there's a lot of information that we can extract by using Elliott Wave. Now, if you don't know Elliott Wave, that's completely okay. You don't have to know anything about Elliott Wave. I'll break this down, and we'll identify some key levels to keep an eye on. Secondly, you'll notice on my chart that I've got these little candles here off to the right. Well, these candles are little because not much has been happening in the market for the past couple of days. It seems ever since we got to Thursday, the U.S. equity markets have just, they've been taking a snooze. These candles represent the last 3 days daily candles. So you notice the label up here that says 1 day. So these are the last 3 days daily candles. So if I were to come back here to the daily chart, for example, and zoom in, you'll notice that the price levels of these last 3 candles are the same price levels as what you would see over here. Okay. All right, so back to the 4-hour chart. So where are we within the trend? Well, within Elliott Wave Theory, an impulse wave is 5 waves. In this case, it's 5 waves bullish. It can also be 5 waves bearish. Okay, so it can also point to the downside like this. And that's what we're going to see on dollar CAD, is we're going to see an impulse wave that's pointed to the downside. But when we take a look at NASDAQ, S&P 500, gold, silver, oil, we're looking at 5 waves to the upside. So let's focus on this for a minute. And it's labeled 1, 2, 3, 4, 5, okay? So when we come over here and take a look at the price action from July the 29th, we can count that we don't quite have 5 waves in place. So if we use this idealized impulse pattern, So we're within the midst of a wave 5. And so I would say we are probably about right here within the larger impulse pattern. Now, what we don't know about this is that this could extend higher, okay? It could go up way, way up here like this, or it could just be a really brief wave 5. So we're not sure at this point how deep it's going to go or how high the 5th wave is going to go, but it appears that we are within, I would say, the early to mid stages of this 5th wave, and that there's still some upside to be had. So being long in a position, we could probably hold on to this for a little bit further. If we're not into the position, might be able to find some strategic entries to get long to try to extract a little bit. But we're not going to want to hold on to this for much of a length of time, because as price gets up here and presses this previous all-time high. So for Nasdaq, it's a little bit higher. So I feel a little bit better about Nasdaq because it has higher to go, whereas S&P 500 has already reached its high. But for just using Nasdaq as the example here, it still has a ways to go up here to get there. So what could happen is that it may come up here and it may top out a little bit. And if it falls shy of this high, and I would say if it falls below, if it falls below like here, then we're probably just going to get a temporary dip and then kind of sweep things out to the downside and then make its run higher. So this is the plan that we're looking at for Nasdaq, is that I am looking for new highs above this high, looking for prices to get up into that 30,000, maybe even up to like 3,300. From there, it could continue to go higher. It could continue to move higher. I'm just not real sure. But this is an area where we may start thinning the herd on the trade size and taking some off the table. So that way, if it continues to move higher, we'll participate. But if it then begins to move lower, we've taken some profits within that particular trade. So for Nasdaq, that's what we're looking at. Looking at continued movement higher. I would say if we dial this into a 1-hour chart, where does price move to the downside? And we're like, hey, this may not be, there's something else going on here. And just looking at this 1-hour chart, that clearly looks like a 3-wave move lower. That clearly looks like a 3-wave move higher. And so we may be looking at a situation that looks something like this. So we might need another jab lower. It's not quite flat pattern, but let's just measure this out. Let's just see if there's any harmony within these waves. And what I'm looking for is that parallel waves tend to have equality or Fibonacci relationship to one another. And so the 618, this is where this next leg lower would be 618, the length of this first leg lower. And so it came down, wicked it, and then it's starting to rally higher. So it's possible that this could be the end of this little dip and that prices are getting ready to work itself higher. I would give this maybe slightly better than 50-50 as to what's going on. I don't have enough price action on this little, I don't have enough price action on this little move to determine. I mean, this looks like this could be an XYZ. I'm sorry, WXY, sorry. If prices move above this trend line, then I would feel more confident that it's working itself higher and it's going to work itself up above this 30,000 level. So I'm just kind of curious what that does from a risk-reward ratio. So if you have a risk down here at this wick low, and then if we target up here, even at 30,000, you're looking at about a 1-to-1 on a trend line break. And I do think that prices could work itself a little bit higher, up here into that about 30,200 range. So you're looking at slightly better than a 1-to-1 risk reward ratio. So there's still a tradable opportunity in here. Now that would be a little more on the conservative side, waiting for this trend line break, basically just drawing it from the high of Monday through today's high, a trend line break of that. If you wanted to be a little more aggressive, we could look to enter in long now and place a risk level below this low. But when you're doing more aggressive style trading, what it does is it just invites that stop loss. It just invites that trade to get stopped out. And it's more likely going to get stopped out if that's the case. It might work out. But in this case, I would want to see more bullish price action before I would be committed into going long. And that more bullish price action would be a break up above that blue trend line. Yeah, I tell you what, Nicole, let's go ahead and hop on over there to gold. All right, I'm going to zoom this out to a 4-hour chart first. Okay, so bigger picture, I'm super excited about the metals. Gold, silver, they were trying to base down here, and it looks like we found a low. Prices were so strong that this decline here couldn't push down to a new low down here. So from this low, this is what we call a truncated wave in Elliott Wave terms. What that means is the market was so strong, it could not push down to a new low below here. And so when you have a truncated wave, that suggests that the end of the entire decline, going back to the all-time high, is over. At least that part of the trend is over. Is the entire decline over? Possible. It might not be, but the odds are shifting that this entire decline from early in 2026 is over, and that prices are building and starting to construct its new bullish wave, that this wave may push it up into new all-time highs. So the way, when you look at that, I look at it from, it's a buy the dip mentality. Wait for these dips to come. These dips are going to offer bullish opportunities. Now, some of the dips are going to be longer and deeper than others. Right now, we're in the midst of a third wave higher. So again, getting back to that idealized impulse pattern, let me just refresh it. Okay, this would be an idealized impulse pattern. Okay, and this would be labeled 1, 2, 3, 4, 5. And so from Elliott Wave terms, let me change the degree of this. Where'd it go? Ah, that's why it's hidden down here. Okay, so I made the degree labels of these Elliott waves to match up. So this one right here would correspond to this one over here. This 2 down here would correspond to this 2 down here. So where are we at within this Elliott wave idealized pattern? We're like right here in the smack middle of this third wave higher. So dips likely going to be temporary, relatively shallow, and that these dips are just going to offer us more opportunities to run this up into higher levels. So, so within this third wave, if I zoom into a 1-hour chart, okay, so here's the end right here at 39.95 is the end of wave 2 and the beginning of that third wave. So within this third wave, we're going to look for 5 waves to count off. 1, 2, and then we may have ended at 3. Now, the challenging part here, if we just ended a wave 3, that means we're going to be looking at a wave 4. Now, if you recall back, this would have been 2 to 3 weeks ago when I was going through, actually, well, no, it was last Tuesday. Wow, it seems like forever ago. But last Tuesday, when Nasdaq and S&P 500 were just screaming higher. When I said we're in the midst of a third wave, there's more upside to be had. What you do is you just mark off, measure off using a Fibonacci retracement tool, the third wave. And then wherever the 236 to 382 retracement level is, that'll give you an idea where fourth wave might go. So that's what this gray box represents, is the price zone where within a retracement, prices may retrace down into it. So I would not be surprised, Nicole, if we saw another dip. Doesn't have to do it, but if we saw another dip, I think it's going to set up a buying opportunity. So it doesn't have to do it, but if we get another dip down like this, I think we're looking good for a buying opportunity. And I would consider that zone to be, you know, probably around 42.80 to about 43.30, you know, somewhere in there. So not much farther below than where we are right now. We've got these two reddish horizontal lines. Those are wave relationships. They're coming into play in about this zone. And then slightly below it is the previous correction where it stopped. So a lot of times after you get 5 waves, prices will revert back to that previous fourth wave, which is right here. So if I were to, and then slightly below that, you have this 382. So if I were to say what the higher probability price zone is, I would say it's probably near these lows and, you know, maybe even just below that low we saw here. So prices do not have to move down lower into this zone, but I wouldn't be surprised if we got a quick spurt lower to kind of flush out, maybe sweep this low, and then it takes off to the upside. You know, so a way that I would play this, because I still think there's more upside to had, and not being in the trade plan that I would do is I would look to buy down here. But if for some reason it just starts to take off and moves up above this high of 44.35, if it moves above 44.35, then I'd probably do a bullish breakout trade. If it digs down here into this gray box, then I'd look to buy, you know, down into this gray box, and then, you know, look for a bullish trade higher. Where would I place a risk level in this? Well, you want to give it some breathing room down to the 382. So I'd probably put a risk level down below this low here, which would be 42.23. Okay. So I would look at a risk level below 42.23, an entry into the green box, and then gray box rather, don't know my colors, and then running higher up here, you know, into the 4,500s and possibly even higher levels. If we did break out above this high, 44.35, then I would place a risk level just below this recent swing low. So it would offer up a slightly different risk reward ratio because you'd have a different entry, you'd have a different risk level. And then by the way, if we did get an entry down here, if prices did come down here, we catch an entry. And then if prices were to break up here to a new high, then I would start moving this stop loss a little bit tighter here. Instead of leaving it down here below this low, I'd probably start moving it up towards this low. And then, you know, as it continues to extend, or if it does continue to extend, then I'd trail that stop loss higher. Well, hey there, Virtual Panda. Glad to see you. Hope glad to have you here in the room. Please kindly gift an account. Well, I'm not at liberty to be able to do that today, but we are in talks about including things like that into the future. So make sure you do stick around, and we may have things like that develop into the future. So we're still ironing out some of those details, but definitely glad to have you here today. I hope you're doing well. Hope your trading's been doing well. And then silver. So I've been toying around with silver more, simply because I think the upside is a little swifter. Silver tends to be the more volatile cousin to gold, Gold tends to be more the kind of the steady eddy. You know, when it hops on a trend, it just goes and goes and goes and goes. Silver seemed to have some cleaner patterns in the beginning and some clear upside. So I've been targeting silver to the upside, you know, eyeballing 70, but there's even, you know, higher price levels coming. It has a very similar pattern, as you can imagine, to gold. From this green arrow or green circle, we have a bullish impulse wave, wave 1, wave 2, and that we are still within the midst of a wave 3. So if we go back to gold real quick, and if I show you the idealized pattern on gold, remember this idealized pattern? I said, hey, we're kind of in the middle of wave 3. Well, when we take a look at silver and we take a look at that idealized pattern, I think that silver is a little less mature. I think silver may be down here a little bit, you know, earlier within the stages of wave 3. So that's why I've been entertaining it, because, you know, when you're making a trade, and this goes for, you know, like Nasdaq, S&P 500, right? They tend to move and operate in the same direction, not always pip for pip, point for point, but they tend to move in the same direction at the same, you know, same speed. Gold and silver are going to move in the same direction at the same speed. So if you're trading both gold and silver, you're basically doubling up on the same trade. So you got to be careful about that, because it's great if they all move in this, you know, if they move in the direction you anticipate, but if they move against the trend that you think is happening, you're basically doubling up your losses. Same thing with Nasdaq and S&P 500. Being in both of those trades is like doubling it up. Nothing wrong with it, but just know that when the market moves against you, you're going to be losing twice as fast. And then it's also the same thing with the US dollar. Some people may think that they're being diversified if they're trading dollar CAD and euro dollar. It's really not diversification. Again, it's a dollar play, assuming that you're trading those in the same direction. So with gold and silver, I just was choosing silver because I felt like it had more upside potential, more swift upside potential than gold. So far, it's lived up to that. We're in the earlier stages of a wave 3. So this could be the end of a wave 3 up here. All right, because within a wave 3, this could be 1, 2, 3, 4, 5. But like gold, still looking for more upside to be had. If we're in the earlier stages of wave 3, as what's depicted over there, then dips will continue to remain shallow like what we've seen here. Dips would remain like this, and then it just kind of continues to grind higher. If we start to see dips get longer in length, the upside, that the uptrend is still intact. It just means that we are farther along in the pattern. Instead of, you know, being down here, we may be closer to up here. So we still have some upside to go, and I still think 70 and possibly higher is is something that I'm looking for silver. So right now we're looking at this 1, 2, you know, smaller degree 1, 2. So I would look for this to take off to the upside with minimal downside movement. If we come down here to this low, then I'm going to begin to wonder if we're more advanced within the silver trend. So as long as we're holding above, what is this, like 63, 65 or so, this could continue to swiftly move higher. And I would call this a fairly swift move higher over the past week. So S&P, so yeah, as I mentioned about Nasdaq, how we're looking at this as being a fifth wave to the upside. So on the S&P, I have loaded in some profit targets. These are some areas because S&P, if I go back to the 4-hour chart, S&P is already pushed up above its June high. It's up here in new all-time high territory. Nasdaq has fallen behind. Nasdaq has not reached up above its June high. S&P has. So the way I'm looking at this is that we're merely completing the fifth wave of a third wave. Okay? And if that's the case, then I would expect prices to dribble up here into one of these two green lines. So this first one is the more conservative green line where it just barely pushes up above this microwave 3 high. So that's up near 78.14. And so we'll look to take the majority of this position off the table at that time. If prices do continue to push higher, you know, it may work itself up here around 78.80. And then that's where I'll be happy just being out of the position. Even though this would be a wave 3 high, and that means there's still a wave 4 and a wave 5 to come. Even though that is the case, this wave 4, you know, could be this could be a decent sized correction to the point of it would be painful to hold through that. So I want to be more or less out of this, you know, as we approach up near these highs. As you can tell, we've already got, well, it's not quite divergence, but if RSI was below its high while price is up here into new high territory, that would also be symptomatic that we are approaching the end of this 5 wave increase, but it would only be the 5 waves of the third wave. So we'd still have a 4th and a 5th to come. So there's still more upside to be had here. I just would be looking to scale back, looking for opportunity, looking for the exits basically. And Dow, I don't know if we have any Dow traders out here. You know, this decline was deep enough that this could be the wave 4. So remember how I said when you finish a wave 3, wave 4s tend to move 236 to 382. Well, that's basically what this gray box represents, and that's right where it fell into. So it's possible that we are looking at a wave 4 that is complete and that Dow may be working on a wave 5 higher. And if so, then, you know, this would be 1 of 5, 2 of 5, and it's getting ready to do, or it's in the early stages of 3 of 5. So if I were going to look to take a position in Dow, for example, what I would do is I would place a risk level just below this low. So that would be just below like 53,800. And then looking to target new highs. So this is a way, you know, if we did it near current price levels, it would look something like this. You know, probably look to take profit just before the high here. So, you know, you're looking at about a 1 to 2.4 risk reward ratio. So, you know, you have a good risk reward ratio simply because the Dow's it's been a laggard, hasn't quite been as strong as S&P 500. So let me go ahead and walk you through this one. You know, I do have some other positions in Nasdaq and S&P 500, but let me just walk you through how one might go about figuring out the trade size, because when we are managing these accounts, you want to think of it like a checking account. So like the checking account you have at your bank, you know, if you had, let's say, $3,000 in it, you don't want to go and blow $3,000, you know, to go out and buy a car or you know, some appliance for your house. You're not going to do that because you still have the electric bill to pay. You still got to buy groceries. You might have to put gas in the car. You might have to buy insurance. You have all these other things that come along with it. So you don't spend all of your checking account on one thing. And that's the same way that you need to look at your trading account. Is that if you have a daily drawdown level, and let's say it's $3,000, Well, you don't want to spend all 3,000 on one trade. You want to divide it up into multiple buckets. And the easiest way to do it is to think of it in terms of 10 buckets or more, maybe even 15 buckets. And so what that means is that you're giving yourself 10 losing trades or 15 losing trades before you'd hit that max daily drawdown. And you may be like, well, Jeremy, that would take forever to reach the top profit target. And well, that's kind of the point, is that when you are putting it all into one trade, yeah, you're going to get a swift resolution. Either it works out or it doesn't. But that type of a strategy ends up losing in the long run. Very few people where they spend all of their checking allowance, all their daily drawdown on one trade, very few of them actually survive over the long run. And so you want to set yourself up for that potential of survivability, because there are times the market's going to move in a direction that you didn't think it was going to move. And so you got to protect against that. And that's what taking your daily drawdown, dividing it up into 10 buckets. So if I were looking at a trading opportunity like this, it's a $100,000 account. So I'm going to look at, let's say, $300 of risk on this trade. Nothing more, nothing less. Then if I were to come out here and if I were going to place a buy trade, then what I want to do is I want to take the smallest trade size possible, 0.001. And then if I place my stop loss down here, this is at 53,801 is the low. So I'm going to set it just below that. I'm just going to do 53,775. Okay. And so at 0.01 lots, it risks about $30. So if I just take this times 10 and do 0.1 lots, well, then I get close to $300. Okay. And if I wanted to refine this a little bit more, I could say maybe it's like 0.11. I get a little bit over $300. But I'm just going to leave this at 0.1 lots. And then I'm going to come up here. I'm going to place a target around this 54.7. Okay, so I'll be risking just below 300 for a profit potential of about 600. Okay, and so with that, we'll go ahead and put that out there, and there it is. So let me get rid of that. Okay, so that's how you would walk through a trade. So that doesn't mean that this is not a trading signal service by any stretch of the imagination. Just displaying how one could go through and analyze the market, and then help you determine, how to find a trade size that might be appropriate for your account size. Because in my opinion, that's one of the biggest misconceptions, or the biggest struggle that people run into, is they don't know what trade size to do. And so they do what kind of feels good. And so then they chuck it out there, and then within a couple hours, their account's toasted. And so here's a way that you can put some math behind it, very simple math, to determine what trade size might be okay for the account size that you're looking for. Okay. Wow. Okay. So we've got to move on here. I want to take a look at oil, and then also dollar CAD. Okay, so for oil, we're on a 4-hour chart. Good. All right. Last Tuesday, what he did, I'm going to go ahead and throw this out into the chat box. So it's got everything tagged on that particular recording from Tuesday. But last Tuesday, we went over oil and was like, look, I like this, longer term to the bullish side, and that we may get a little bit of a dip before prices move higher again to the bullish side. And everything was laid out at that stamped marker that I just placed to that link into the chat box. So, grab that, maybe just pause it. You can watch it later. But was looking down here at 74. I even threw in a slightly lower level down here at 70. Okay, so prices did come rest on 74, and now they're taking off to the upside. it's cleared both of the resistance levels that I talked about in that clip. It cleared this downward sloping resistance trend line. It cleared this previous horizontal resistance as well. So this is looking bullish, okay? It's getting its bullish mojo in again. And so off of this low, I think what we're looking at is within that 5-wave bullish impulse, it looks like it's going to be bottoming out here in wave 4, microwave 4, and then that would lead to a microwave 5 higher that would retest this high. So if you're a shorter term trader looking for, you know, something that's a little bit quicker, this might be one of those trades. Because if I use my Fibonacci retracement level from that low up to this high, you notice how I say price usually retraces into that 236, 382. It came right to the bottom end of this at the 382 level. So this is a price zone where prices may want to go ahead and rally further. Now it is running into some larger resistance back here. So if we take a look at, you know, this zone, this is going to be an area that prices may struggle with. So if this is a wave 4 low, what may happen, let me get this blue arrow off of there. That was from last Tuesday. So what may happen is we may get this rally and it may come up here into this box and it may get rejected. And then we come back down here to retest this price low, maybe even lower levels, and then we head up even higher from here. So I do think that even though we may get a dip coming, another rejection of this gray box, I do think that eventually that gray box is going to break and that we're going to fill this gap, you know, up here above 87, 86. I wouldn't be surprised to see triple digits oil again. I think we're at a decent spot here where we may get a little bit of a rally developing. So if we come out here, if we just take a look at a risk reward. So it would be a little too tight to place a risk level here because this could dance around sideways. We may get a quick wick lower and then it would take off to the upside. So you want to be careful, in my opinion, not to place a stop loss too close to this low. Otherwise, you invite the potential to get wicked out. And a way I would look at this is I would like to extend it a little bit further down. According to Elliott Wave Theory, prices would need to hold up above this high, which is at 77.88. So prices, according for this Elliott Wave count to be correct, would need to hold up above there. But oftentimes, if it bleeds below the 618, you know, there's not much room between that 618 and here. So here's a way that you can place a stop loss around that 618 and get it slightly tighter, slightly better risk reward ratio. And then, you know, if we look at a profit target at the lower end of this gray box, it's about a 1-to-1 risk reward ratio. So it's not quite a risk reward ratio that would light the world on fire, but it is a tradable opportunity. I would look at this as, you know, something that may get our wave 5 up here into this gray box. And if it gets rejected, that's okay. If it starts blowing through that gray box, you know, it might, you know, wave 5 could extend even on higher up here. But on the more conservative end, I think this gray box may reject prices. So about a 1-to-1 risk reward ratio from near levels to run it up there with a stop loss, I would say down here around 78.50. And then targeting, you know, around 84.15 to the upside. I would want to be out of this trade, or if you're going to use multiple lots, peel off the majority of your trade position by the time you get up here. And if you wanted to leave a little bit on, you know, as this runs higher, that's another way to play it as well. I've been known to do that, but since this is a pretty small trade anyway, I usually do the multiple lots, peel it off when I have a larger position, larger trend rather, going on. But in this case, it would be a small, shorter, smaller trend. So I would probably just do it kind of as an all or nothing. Either it hits my take profit or it hits a stop loss, you know, it hits one or the other. So stronger oil price is what we're looking at for there, and eventually running up here above this 92. Gosh, if we were to look at this over a longer term scale, let me zoom this out to 4 hours. So we came down here just below the 618, so it may double top up here around 92. So yeah, around 89 and then 101. So basically, yeah, about your 100. Now it does have this longer term resistance trend line going back to April that it would need to contend with. If it breaks up above there, I think it works itself up to 100. So yeah, over the next several weeks, I think we're seeing higher oil prices coming. I read a report, has nothing to do with technical analysis. I forget exactly where it came from, but they were talking about how, you know, there's still a supply constriction going on, and that, you know, have we reached the bottom of the strategic reserve tanks? As you can imagine, you know, if you've got a container of, let's say, lemonade, and you're at a party and you're drinking the lemonade, you're pouring it out of the container, you know, through the spout. When you turn on the spout and the lemonade comes down through, well, once you get to the bottom of that lemonade jar, that lemonade container, you're never really able to get all of the lemonade out. There's always a little bit in there. And so that's the point that these people were making, was that even though there may be how many, you know, hundreds of thousands of barrels in the strategic oil reserve, you're not always able to get the last barrel out of the strategic reserve. You know, there may be sludge and other things down at the bottom. And plus, it doesn't line up with the spout. No matter how much you tip it, you can't get it out. So, so they were arguing, or they were suggesting that we're getting close to the bottom, and that there may be a pinch coming, a supply constriction coming. Well, the supply constriction's already happened, but the price may reflect the supply constriction, I guess is what they were saying. So yeah, I'm looking to the upside for oil. Now, if oil is moving to the upside, and when we look at FX, dollar CAD might be moving to the downside. So the Canada has is a big oil exporter. So when the price of oil moves higher, a lot of times the Canadian dollar can benefit from that. And I'm looking for a weaker dollar anyway with stronger oil. Those two things line up to where this dollar CAD may be poised for lower levels to come. And that's what I'm looking at here. So last Thursday, in last Thursday's live stream, I had introduced the idea of what I was looking at for dollar CAD and looking for lower levels. Then on the heels of the non-farm payrolls and the Canadian jobs report on Friday, that's what this large red candle is, and it was zooming lower. And so it was shortly after that when I had entered into the short position and looking to ride this down. Now, where are we at within the idealized Elliott wave? So we've got wave 1 down here, wave 2, and that we are still within wave 3. So we seem to be relatively early within this bearish impulse pattern, this bearish Elliott wave trend. And I think this works itself down here to 38.80, might even work itself down here to 37.40 for wave 3, okay? So wave 3 might carry us down here. That would leave us still with a wave 4 to come, and then even a wave 5 to lower levels. This would be a fairly heavy retracement to hold through. So I don't know if that's worth holding through, but, trying to catch the meat of wave 3 to the downside, the meat of it's going to carry us down here to about this, 38.80 range. But this wave 3 could carry all the way down here to 37.40. So I like over, these next several days, next couple of weeks, I like dollar CAD working itself lower. So within this third wave, so this third wave starts here, okay? And we're about partway through it right now. So it needs to subdivide in 5 waves. So we've got 1, 2, and then now we're working on 3. Okay, so we're still not quite finished with this third wave lower. And this would be 3 of 3. And then we'd get a little bit of a bump in wave 4 of 3, and then one last dump lower in wave 5 of 3. So I think rallies are likely going to be brief, probably not much bigger than this rally we saw here. So this rally went from around 39.90. So this rally was about 90 pips. So I think you're going to see rallies be contained less than 100 pips, maybe more in that 50, 60 range, which is, just a normal breathing action for dollar CAD. That's why I like this to the downside. More downside available, upside, as possible, but they look to be fairly temporary, fairly brief coming up here. And for those that are watching at home, let me get that timestamp to you in the chat box of where we talked about dollar CAD last Thursday. So there's the link. When you click on that link, it'll take you to Thursday's recording, timestamped from where we were talking about dollar CAD. Other than dollar CAD, I mean, the euro dollar is the other one that's got my interest. I flipped from looking to the bear side. I'm still not 100% convinced that the low is in. I could see patterns that go both ways here on euro dollar. What I mean by that is that this could just be a 3-wave rally, and that, soon it may top out and retest the lows down here. I can also see where this low was a truncated wave, like what we were talking about in gold. This was a truncated wave, and that euro dollar's in the beginning stages of a very weak trend to the upside. So when I look at, and I hate to say this, but the dollar CAD, how it looks to be a wave 3 to the downside, dollar weakness, Canadian dollar strength. So playing off of that dollar weakness, also considering that, maybe euro or dollar weakness may take its place against the euro as well, and that this is working itself higher off of a truncated wave. And so I'm keeping this one on a tight leash, that if we get below this low here, that doesn't mean that the bullish trend is totally out of the picture, but the bullish trend is severely wounded, simply because prices are trying to break up above this resistance trend line, this blue resistance trend line. It's trying to break up above it. And so if it were to work itself back down here, it'd be like you get that false break higher and then it pushes back inside that trend line. That would be too much for me to bear on wanting to continue to the long side. So I'm hoping that this can get up above the swing high that we saw last week. Actually, that would have been Friday. Hoping we could get up above there soon. And then I could tighten the stop loss up even further. Up here, this take profit level, I believe that is, yeah, the 200-day simple moving average is up near there. So if we get up there, I'd be perfectly happy just calling in the dogs and putting out the fire and being done with it. This one I'm losing some patience on. Just it broke the trend line and then it's just sitting there. It's I don't know that it's even thinking about what it's wanting to do. It's just sitting there. So pound dollar, you know, it's sitting right up above the 786 of this previous decline. So the 786 level, the Fibonacci retracement 786, is considered to be the Fibonacci of last resort. If this doesn't repel prices, then oftentimes it'll come up and retrace, you know, the rest of it up here to the 100% level and possibly even higher. So it's reached this, kind of sat around, it's done nothing. I don't see anything. I mean, there is a good risk reward ratio trade here to go short, but because of the other dollar CAD, euro dollar trades I have in place, and also going short pound dollar would basically be doing the opposite. It'd be basically hedging the dollar CAD, euro dollar trade. I don't want to do that. Its direction of the dollar would be the opposite of what I'm looking at. This would be dollar strength if pound dollar goes to the downside. I was looking at dollar weakness against the CAD. I was looking at dollar weakness against the euro. So in essence, this trade would hedge that. All that simply means is that one of them would probably work out. They both probably would not. And so again, when I think about that checking account analogy that I've shared with you earlier in this session, you know, if I've got 10 buckets, you know, 10 trades or buckets of trades that I want to try to make them be higher probability ones and not just jabbing at them because, you know, because they're waving at me. So this one might work out to the downside and both euro dollar and dollar CAD might be wrong. But I feel more convicted about what's going on with dollar CAD than what's going on pound dollar. So if I had to pick one, I would lean into, for me, I'm leaning into the dollar CAD. So Aussie earlier today, the RBA came out with their rate announcement. They decided to hold rates steady. And as a result, we got a little bit of a bump higher here on Aussie. I think Aussie just has not been behaving the way that I thought it was going to. And so therefore, Aussie just is not on my radar of things to any interest in wanting to trade it until it starts to behave the way I think, according to my analysis, the way I think it would be behaving. So it's misbehaving right now is what I'm saying. Looks like we've got wave A lower and that this sloppy, choppy rise is just a wave B rally. And that eventually I'm looking at a wave C lower that would break down below this low. So I'm eventually looking at something like this, but just pinpointing where that top is, it's been a little elusive right now. This gray box, I was initially identified as a potential topping zone. Well, it hit it on Friday. So I thought that was going to be it. However, it's just not moving to the downside. And looks like it may want to come up here and retest this high. So maybe it just digs a little bit deeper into this gray box and holds this gray box. The next zone is up here with this gray box near 71.15, 71.20. So, you know, within the next 50 pips, I wouldn't be surprised if Aussie dollar tops and this becomes a wave B top, and then that leads to a wave C lower. Again, that retests this low, and we get another move of similar size or Fibonacci proportions to this. This wave A decline went from about 72.78 down to 68, 66. So it was about 400 pips. So this next decline could be, you know, 300 to 600 pips. All right. So it'd be a decent little move. I just wouldn't want to get caught in a bunch of false starts to the downside. I'd like to see some of these support levels crack before I get too excited about it. So I would start with this blue trend line right here. If this blue trend line cracks, then okay, maybe a top has been in place. After that, I would start looking at horizontal levels. So if that blue line cracks and then this horizontal level breaks, then I would say, all right, maybe we can call this as a medium-term top, a wave B top, and that prices are working themselves lower in a wave C decline. Just real quick here on dollar yen. I'm not a huge fan of trading dollar yen right now, just simply because of all the intervention. It reminds me of way back when here. Well, I don't have it on this chart, but it reminds me back in 2015, I think it was. Maybe it was 2011. I think it was 2011. Yeah. It reminds me back then when the Bank of Japan was doing a lot of intervention. And at that time, they were intervening to weaken their currency. So dollar yen was moving lower, moving lower, moving lower. Yeah, I think it was 2011 where dollar yen was at extremely historically low levels. And the Bank of Japan was intervening to try to weaken their currency to push dollar yen exchange rate higher. It was very difficult to trade at that time because it was just slopping around and you just didn't know when the Bank of Japan was going to intervene into the market. And that's the same situation as it is right now. The Elliott Wave pattern suggests that we might get a partial retracement higher and then another move lower below 155. So putting the Bank of Japan aside and just looking at the pure price action pattern, this would suggest we get a retracement into this gray box. And from the gray box starts another move lower. You know, so maybe it does something like this. But it's really hard to say if and when the Bank of Japan would intervene and do something within the market. So we'll have to see how that shakes out. Because of that, I'm not a huge fan of really trading it. Might look at it from time to time, but when it comes to, again, if you have the 10 buckets and you're allocating capital into one of those buckets or the others, you know, I'm going to take a look at other markets relative to the Bank of Japan and dollar yen. All right, well, that is all the time that we have here for today. I want to wish you all the best of luck in your trading. We will talk to you soon. We'll be back here next Thursday. Today's Tuesday, so Thursday the 13th. Same bat time, same bat channel. So go ahead and like and subscribe if you like what you've seen here. Set up a notification. We'll meet you back here on Thursday. Until then, we will talk to you soon. Y'all take care. Bye now.